Okay, real estate investors, case study number 4. We're going to start to look at some larger numbers here. So in this case, or case study, I should say, we're going to look at a 50-year-old male funding $100,000 per year into a policy, let me rephrase, one with the ability to go up to $100,000 per year for 10 years, not committed to, and then stopping altogether. And this is something we hear often. A lot of times individuals will say, hey, I was looking at policies, but I'm always told you should pay in as long as possible, which a lot of times makes sense, but the individual states, I don't want to do that. Like, I'm done after 10 years and I just want to live off of this as income. This is my plan. Can I do it? The answer is yes. So here we've got 50-year-old, 100K for 10 years, purchasing 3 properties, 150K in year 2, 300,000 out of the policy in year 7, and then year 11, 500,000. Now, something I want to touch on real quick here, because this is valuable. With this policy, so I've got the ability to put in $100,000 per year, but I am not committed to it. So how we are literally designing this is our premium is actually set at $10,000. To be specific on this example, we set it at $9,100. We've got a term rider in there as well. The MEC limit is over 100K. We overinflated it to ensure that we would never run into a modified endowment contract. So this is great for an individual, say a 50-year-old male, who has a $100,000 target and says, hey, I can hit that each year, but my cash flow fluctuates and I don't want to get a bill for it each year. So literally, we designed the policy where they commit to this. So a bit more than that, they've got to cover the term cost. It's about $10,500 to $11,000 per year. MEC limits at 100K. So the insurance company will allow them to pay another $91,000 per year into PUA so they can 10x their base premium. 10x PUA, and that's this particular insurance company. So that's the insurance company limit, and then we have the IRS limit as well. So let's take a look here, because this one was fun. They all are, to be honest. A little extra gravy here. This is actually with a direct recognition company here, and a direct recognition company that raises the dividend rate, and they have, as far back as I can remember, again, they raise the dividend rate on borrowed funds. There are 3 companies I know that do that, and they are 3 of the 4 major mutual carriers. So here we go. Major mutuals being Mass, Guardian, New York Life, and Northwestern Mutual. We disclose this particular company in our membership program, or if you're working with us, we'll tell you. So the growth example, $100,000 for 10 years. 88% equity right off the bat, meaning I pay in $100,000, $88,000 is available in cash value. The base premium did not show up in cash value. The company overcharged me for the base premium in number 1 for the cost of insurance. The term rider did not show up in cash value. There's also a PUA fee, which is why I only see 88. There's a 12K hit there, really. Beginning year 2, you'll see I pay in $100,000. I get that 100 back plus another $1,200. Now dividends are beginning to accrue, but it's picking up the pace. I'm positive year 4. Which frankly, I want to get positive as soon as possible because again, it gives me more cash value to work with, more capital to invest in real estate, to do other things with. Because again, where I'm going to make money, if you're a real estate investor or if you're thinking about it, you're going to make money in real estate. And the purpose of a cash value life insurance policy is to complement that. So the best means to complement it is to get as much capital as possible, making sure we don't mech out or anything like that, which is quite simple to do, but designing it where it's cash rich so we can then enhance our real estate portfolio as quickly as possible. Because time, that's it. Time is money. All right, so let's take a look here. This example is going to demonstrate paying interest only. Year 2, $150,000 loan. The loan interest on this example is 5.66%. That's why it's about $8,500. When I take that $150,000 loan out, because I'm still going to receive dividends on what? Money in cash value and the money outstanding in policy loans. The same $189,000 as if I never touched it in the first place. How that happens, loan interest expense of that $84.91 goes to the insurance company, and they collateralize my death benefit. Dropped dollar for dollar. $150,000 loan, $150,000 death benefit reduction. And what's interesting, when we model scenarios where we only pay the loan interest, you can see that it's a constant, let's put it that way. We see that constantly in the sense that we've got the $150,000 loan, then we pull out a $300,000 loan, taking your balance up to $450,000. Look at this, $3 million minus $450,000 is $2.55. Death benefits collateralized by the loan balance. And we're covering the loan interest expense out of pocket. If you say, hey, I'd like to get a much lower interest rate than that because I can elsewhere, that's where our default, if you haven't watched our overview video on the cash value collateral loans, you've got a potential tax deduction there. I'm not a CPA or tax attorney, so I'm not giving any advice there. But when working with lenders, banks, or a cash value collateral loan boutique lender, they often have attorneys that provide paperwork specifying it's a business loan and you can capture a tax deduction. It's a nice resource. When you've got that $300K loan, down here I take a $500,000 loan. There's the collateralized death benefit. Now it drops again in year 11 because we executed what's called a reduced paid up. All that means is we chop the premium off, drop the death benefit. I wanted to optimize the cash value growth with the assumption of no more payments going into the policy. It's interesting, right? When we think about cash value life insurance, all the things we can do with it here. So, loan interest expense over time. Now, one thing I want to point out here is we paid in $1 million, but you pulled out, well, there you go, $950. You've got $212,000 in cash value. Sounds great, but I actually paid more than that out of pocket because I do have to account for the loan interest. And here, we just pay the loan interest. Now, one thing I want to highlight here is this loan interest expense drops at age 65, or I'm sorry, at year 21, to just under 4%, 3.66%. This particular company has a nice niche there in the marketplace. So we see the loan interest expense drop if I'm continuously paying the interest out of pocket. Let's look at the repayment options here. Number one, I'm going to pay the loan interest and the principal balance together. So this is a lot of cash flow out of pocket. Depends if the individual can swing this. Some we work with do, and they do quite well. But again, you don't have to. Growth, this is the gauge to compare everything. $100,000 into the policy for 10 years. Here's my loans, just like the last scenario we saw. Death benefit, dropped dollar for dollar. The amount I can pull that I can actually borrow from the policy, call it my available equity, is whatever I have in cash value, yet I'm still going to receive appreciation on my entire cash value as if I never touched it in the first place. Uninterrupted compounding. In this example, got the loan interest expense. It's in purple. That represents I'm paying it out of pocket at the end of each year, plus another $50,000 each year, plus the $100,000 out of pocket. He's paying this thing off aggressively. Now what I want to highlight is when it's all said and done, death benefits fully restored to what it would have been otherwise. Same thing with the cash value. 100% restored to what it would have been as if I never touched it in the first place. Actually a little bit higher. The reason why goes back to the beginning of the video when we mentioned this is a direct recognition company that raises the dividend rate on borrowed funds. They give you a slight bump, which is why you see a ever so slight bump on the cash value difference here. Same thing with the repayments. So let's look at the 500K loan. When you take 500K out, what happens to the death benefit? It's year 11 in this example. There's the drop. 500,000. Cash value, that's the equity I can pull. That drops as well. Now we've got the loan interest, 28,000, 26,000, and there's the loan payment. This assumes that I pay the loan interest out of pocket and throw an additional 30,000 at the loan balance. So we're plugging cash flow at this example, plugging away at it. 56,000 that year now. At the same time, we're assuming the real estate's producing because my out of pocket here is 0. So I'm using that income producing real estate to cash flow the loan interest and principal balance. Let's look at the end of the road. Fully restored. And again, I know this is technical, which we like providing more detail rather than just concept. If you're digging for more detail, this is ultimately what real estate investors do with this stuff. Because again, this keeps moving for them. They've got the guarantees, the security, peace of mind, convenience. Going back to the intro video, it's very convenient. I've got access to my capital. So I can continue to use this to fund my business as much as I like. And the key thing is just keep moving forward. Real quickly here, we looked at a more simplistic example. Same policy, same everything. Loans coming out, same 3 loans, but not paying the loan interest at the end of each year. So this would assume the investor said, hey, I'm not into that. I don't want to pay the interest at the end of each year. That's why I bought this policy, for the convenience. But a lot of people are attracted to that. Maybe they will, but they see the numbers, they get it from a financial standpoint and say, like, no, I'm going to pay it back however I want to pay it back. I bought it for the control factor. And I 100% understand and get that. Again, like, my viewpoint is show the numbers, show the options, show what makes the most sense from a financial standpoint, but then ultimately we as the consumer can make the decision that we want to. At least that's what you'll get working with us. No, most agents work like that too. So just paying $50,000 per year, that covers the loan interest expense. The rest goes towards the principal. There we go. Fully restored when it's all said and done, which is exactly what we want. So this one was a ton of fun. If you have any questions, please reach out. We'd love to work with you. If you'd like to talk about real estate opportunities and such, or if you'd like to work with us, if you are a heavy-duty real estate investor or you have any experience with real estate investing and you'd like to work with us, always happy to talk, and we'll talk to you soon. Again, thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.